Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I've got Michael Gilburd, President of ValuCorp, on the show with me today. Michael, welcome to the show.
Thank you. Great to be here.
All right, give us an idea of ValuCorp, what they do, and then I've got a lot of questions for you. I'll dive right into them.
Okay. ValuCorp is actually an international, but primarily U.S. business valuation, intangible appraisal firm that also provides fairness opinions and things of that nature to companies in any one of a number of capital markets transactions, which could be raising money, selling, buying, getting divorced, getting married, bringing in employees, employee stock options, things of that nature.
How long have you been in business?
As ValuCorp, this is our 20th year. Before that, I ran the departments for American Express. Before that, BDO. And before that, I was an internal revenue agent where I really learned a lot.
I'll bet you did. And you met some colorful people, I'm sure. All right, Michael, this is a really good question, and everybody has the same question, especially people in my industry. How do you find out what your business is really worth?
Well, as you might think, my approach or my advice is to hire a professional appraiser, because a professional appraiser will look at all aspects of the business. The big three are the asset approach, the income approach, and the market approach, depending on the stage of the business. The appraiser may land on one of them, use two, or use three, giving them a weighting depending on the circumstances. And then there are a bunch of premiums and discounts. During that process, one of the most important things is recasting. For example, just yesterday, I was talking to somebody that had an interest in possibly selling their business, but they had a theft over the past 3 years of $1.5 million. So the recasting to normalize what would have happened without the theft is critically important.
I get it. The approaches and the methodologies, you kind of walk through those with us. So let's talk about if there is such a thing as rule of thumb probability, whether it does or it doesn't work. And I'm sure that depends on the asset class and the type of business that you're in, but address that question that comes up often to me.
Sure. And also with rule of thumb, size matters. So rules of thumb are used usually in a business brokerage size transaction, which is in the hundreds of thousands, maybe getting toward $1 million. So it's good for laundries, bar and grill, restaurants, dry cleaners, businesses of that nature. Once you get to the million or more transaction, or value, I should say, then you want to look at the asset approach, the income approach, and the market approach. So in the asset approach, you look at assets minus liabilities two ways: what's on the balance sheet, what the cost is, and what the fair market value of those assets are. And the fair market value of the assets could include a very large number for intangible assets, and an intangible appraisal becomes part of that. In the income approach, the primary methods are discounted future cash flow and capitalization of cash flow. And we could get into that a little bit if you like.
I would.
And the market approach, it's comparable transactions, public company multiples, and general multiples in the industry. In any of these, the challenge from back to the rule of thumb all the way up to the larger companies are things like numbers of employees, which now is becoming less and less important as things become automated, but also location, room for expansion, whether or not the business can be replicated. Will the hamburger taste the same in Dallas as it does in Phoenix? Things of that nature.
I got it. Let's go back to that middle approach that you were talking about. We're going to drill down on that one.
On which one?
The second approach that you were talking about.
The income approach.
That's right. Income, discount future income. Think that.
Okay. So if somebody's buying a shopping center with a cap rate of 8%, it's the same as buying a business with a cap rate of 8%. However, it becomes more complicated when you use a discounted future cash flow. And this is important even for startups and mature companies, because the buyer or the investor is looking at what the future has, not what has happened to date, other than as a foundation. So if somebody runs their projected income statement, and usually it should be no more than 3 or 4 years, and I advise people in the first year to do it monthly, second year quarterly, third and fourth annually. The critical area that many folks skip, and they really should do this, is not only run their income statement or their cash flow, but also their balance sheets. Because how long it takes to collect money, or if you're building up inventory, is critical either for a sale or for an investor.
Makes good sense.
Yeah, and then there are different cap rates, as I mentioned, capitalization of cash flow, that get involved in the discounted cash flow method.
Okay.
So in that area, the other item that's critical that folks should focus more on from the deals that I've seen are the assumptions. The more assumptions, the better, tying them into whatever numbers are being used to get to a value.
Okay, I get it. Is there a size that a business needs to be to be valued?
No, we get involved with companies from zero, no revenues, or $100 of revenue to hundreds of millions of revenue.
What about?
And startups often make the mistake of not getting valued. What they do is a reverse kind of thing where they say, oh, we need $500,000 for the next 6 months, and we only want to give away 20%, so therefore our company is worth $2.5 million. So even a raw startup could be valued if they use the right approaches, the 3 approaches I mentioned. So the first approach, the asset approach, would only be valuable if there are assets, intangible assets, that are worth a lot. The income approach should always be applied for discounted future cash flow. And the other thing that the discounted future cash flow gives the company or the entrepreneur is comfort for the use of proceeds. Will they have enough money to implement the plan, which is, again, why assumptions are so important. And the assumptions, of course, should include the use of proceeds.
Public and private companies, is there anything special we need to know about the differentiation on valuation with that?
Well, actually, the private companies go through the same drill as we do with public companies, because a public company may be trading at a certain number, and when you do the math, you say, well, 10 million shares are outstanding and it's trading at $5, so it's a $50 million company. That may or may not be true, because that depends on trading volume and the factors that I mentioned in the approaches, as I said before. So a private company should use the three approaches. They should definitely look at public company comparables. But there are other comparables that they should look at, because when you look at public companies, you're getting involved in the market approach. And the market approach looks at public companies, it looks at private company transactions, and different metrics that are involved in the business. I'll give you a very good example of something I'm working on now. A social media company that's at an early stage is looking at raising money, or I should say they are raising money. So the valuation in social media depends largely on average monthly users. So depending on your average monthly users will create a value for the company. So the matrix is how long it will take to obtain X amount of users and what is that user worth. So what we do is we look at other public companies, Facebook, Amazon, wherever information is available. We look at their market cap, and we look to find how many average monthly users they have and divide the market cap by that amount and say, okay, that's how much a user is worth. Well, how do we get those users? Well, what's happening currently, there are two major ways to get them. One is social influencers who have a large number of followers, and the other is people are actually buying monthly users so that they could build up their base. And the reason you want a lot of monthly users is that's how you get advertising dollars.
Right, that makes sense, yes. So, that being said, that's not the end of the statement, because that's not, we all know that that's what they want to do. Let's circle back and move forward though. Startups, early stage companies. Tell me about, because this can be really tricky on the valuation. I've seen pre-revenue companies come out, and next thing you know, I mean, they've got $1 billion valuation, and the math behind it sometimes leads me to just scratch my head. So talk to me about this.
Okay. Part of that is based on their discounted future cash flow. Mm-hmm. And part of that, in the example I gave you for a social media company,
right, is
how many users they plan on attracting over a certain amount of time.
And the feasibility of that growth rate being an enterprise trajectory? Is that what I'm getting?
Yes, and the probability of success. So there are things we use to determine the probability of success. So one of the keys for success is bringing in management that has done it before or has an exquisite reputation in the industry. Another key to success is the entrepreneur knowing that at a certain stage they'll step down. Happens often, and often it does not happen. Right? Facebook continues with Mark Zuckerberg, and he's doing a great job and has a great following and a great market cap, whereas in many other social media companies, the steering wheel has been turned over. So part of the reason a company gets there are actually three things that I really want to emphasize. One is unique attributes. What is really unique about the company or the business model that can be implemented? And the second, as I mentioned, is management of a view where they'll either bring in first-rate help or they're prepared to step aside. when we look at the value and you say, oh, they're astronomical values, they are. And another thing I'd like folks to keep in mind is the rule of 4-4-40, which means that if the investor at the IPO price or the venture capitalist receives 4 times their money in 4 years, they have a 40% internal rate of return. Very key in looking at values of companies and how that will play out.
Well said.
And in looking at valuations and how companies prepare themselves from startup to finish, too often we'll see, oh, we're going to go public in 3 years, or we're going to sell in 3 years. It would behoove the management to show 3 or 4 or 5 capital markets alternatives so that they don't appear to be stuck in one method. And the one method they're thinking about for a liquidity event may or may not be appropriate for their business. So unless they're investment banker types, I recommend they just show 3, 4, 5 capital markets alternatives. So those are really the 3 or 4 keys that I advise early stage companies to focus on.
Great. Michael, thanks for being a guest on the show. I know we're going to have many more conversations as you go through various examples of everything that we just started the conversation with today. Thanks for being here.
You're very welcome. Thank you for having me.
My pleasure. All right, you've been watching CEO Money. Thanks for joining with us today. Don't forget to follow us on Facebook and subscribe to our YouTube channel. We'll be back with more great content on the next video we put up for you. Thank you.